Hi everyone, welcome to PK Tutor. Today we are going to solve some high quality FRM Part 2 questions with complete explanations. Since detailed solutions for Part 2 are very limited online, this video will help you understand not just the answer but the logic behind it. Let's start the first question and break it down step by step. So we are starting with Book 1, Market Risk Measurement and Management. This is reading 1, Estimating Market Risk Measures, an introduction and overview. So we'll start with the VaR calculations. Question number 1. It says portfolio A has a total asset. So this is our portfolio value and an expected return. So this is our mu. Historical VaR at 5%. This is the significance level, and this will give us the confidence interval of 95% and z value of 1.645, and this is our VaR. And they are asking to calculate the portfolio's standard deviation. We have to calculate the portfolio's standard deviation. We know the formula. VaR is equal to the expected return plus the standard deviation z value, which is multiplied by the portfolio value. We have been giving the VaR as 2.4 million. The return is plus sigma value we have to calculate. PV is equal to 14 million. So after rearranging and calculating, you can pause the video and see the answer. This will come to sigma of return is 17.97%. So this is the answer. Moving towards the question number 2, it says that we have to calculate the 1 day VaR. We have to calculate the 1 day VaR. We know that it is equal to what? It is equal to plus the z level, the sigma of return into the portfolio value. So they are given the portfolio value. The return volatility, this will go here, 95%, so this is 1.645, this will go here, and they have not given the mu. So if they have not given the mu, then it is not necessary to include it. We can just ignore it, and the VaR will be equal to, so this is 0, this is 1.645 into the standard deviation of the return and the portfolio value, which is 12.358674, and take a pause. You will get answer 203918. So this is the answer. Moving forward, so this is question linked with the other one. We have already calculated, this is 1 day VaR. So now we want to calculate the 10 day VaR on the same data. So you know the scaling factor, the root T rule. So using the same, you can just you know the answer here is 203918 into the root 10. Take your calculator, just see, it will be 644845. So this is the answer. So now moving towards question number 4. Now this is a theory question, and theory question these days FRM mostly they ask theory questions. Which is the following statement regarding value at risk and expected shortfall least accurate? You note down that you have to find the least accurate between value at risk and expected shortfall. Okay, so the ES provides an estimate of the tail losses by averaging the VaR for increasing confidence level in the tail. So this is the true statement. This is true. If you see, this is the VaR level, and you take all the average here. So this will be yes, and this is what it is stating, the same. This is true. The calculation of log normal VaR and normal VaR will be similar when dealing with the long time period. Yeah, this is also true. The calculated VaR amount is typically reported as a positive value. Yes, we know that it is a loss, so there is no meaning of writing a loss of minus 2 million. So we directly write loss of 2 million. So this is also true. And as the number of VaR observers in the ES will increase. This is also true. Wait a minute, we made some mistake. This one is false. I'm sorry, I just went in the flow. The log normal and normal VaR will not be similar when dealing with the long time period. Okay, now going to question number 5. You can directly come to the last part and you can understand means what they are exactly asking to calculate in this question. So if we read it, we get which of the following amount is close to VaR at 99. Okay, so again we know the formula. Every time you write the formula, it is mu plus sigma of return z value and the portfolio value. So you look for what they are giving. They are giving annual mean. Now they are giving the dollar amount. Okay, now they are giving the dollar amount. So this will be minus 20. Standard deviation is given 13. 99. So for 99, the z value we will use 2.33. This is 2.33. And what are they asking? Okay, already dollar amount is giving, so PV not to be used. So just calculate, and this will come to 10.29. So this is the answer. Now going to the 6th question. Okay, proper interpretation of this statement. So what is the statement? The statement is the 10Q report. Okay, there is some form 10Q. They are report. There is a report on the global bank states that monthly. See, the VaR will have 3 things: time, amount, and probability. So this is the time factor monthly. So the value is this much, amount is given, and they are given the confidence level. So this is the probability. So which is the proper one? Okay, so let's start reading first one. There is a 5% probability that the bank will lose less than 10 million over a month. There is no confusion, it is very clear. You read it properly that the monthly VaR of bank is 10 million at 95. So that means there is a 95% chance that bank will lose less than 10 million. So this is not the correct answer. If we collect, so there is nowhere given that if we collect this one, so this is also wrong. There is a 5% probability that bank will gain. So we are talking about loss. So finally we are left out with this D1. There is a 95% probability that the bank will lose less than 10 million over a month. So this is the answer. Question number 7. Okay, if the one day Okay, coming to the what the question is on, this means that we should expect that in 1 day out of, okay, again see, I told you the VaR will have the amount, it will have the probability, and it will have the time. So 1 day. So what it is saying that there is 95% probability. So out of 100 days, 95 day, if you see, the loss will be less than 50,000. Five days. Okay, now question number 7. Again, there is an interpretation. What the meaning of this? So this is time, 1 day, amount, and the probability. So it is saying that the 1 day VAR, the value at risk of a portfolio, is $50,000 at a 95%. So that means there is a 5% chance of loss more than 50,000. $50,000 or more. The 5 out of 100 is equal to 1 by 20. So there is it cannot give a perfect answer that you will lose this much. It will be less. This is 25 days, but we will lose less than. Increase, it will not. There is no such concept of giving increasing number. Decline is also not there. This is the right answer. A 95% 1 day portfolio value at risk means that 5 out of 100 or 1 out of 20. 5 out of 100, that is equal to 1 out of 20. The value of the portfolio will experience loss. Now coming to question number 8. This is a time taking question. We have to calculate the historical VaR because this monthly return is given. So 40 months data, 1 2 3 4 5 1 2 3 4 5 6 7 8 40 months. So you have to rearrange it in ascending order because negative will be the first one here, so the least one. So if you see 22 34, this is 34 32 32, I'm getting the least one as 32.75, then I have 33.56, I have 32.26 here, so I have the least 34.75, then I have 34.26, I have 33.56, I have 33.16. Okay, now they are giving 5%. So 5% of 40, that is 2. So I have to take this one. This is the return. So that is very easy. Now what is the portfolio value? 20 million. So it is 20 million into 0.3426, that gives 6 0.852. Coming to question number 9. This is a theory exam. VaR is a benchmark associated with given probability. The actual loss. See, what is VaR? This point is given VaR. This is loss. So the actual loss could be greater. The actual loss could be greater in the tail. Cannot exceed this amount. Cannot exceed this amount. No, it can exceed. Is expected to be the average expected return of the portfolio, or it is not the average. Will have an inverse relationship with VaR. There is no such relationship. Must be greater. So D is the answer. Coming to the final question of the day, question number 10. There are several different methods commonly used to compute value at risk. Which of the following is historical VaR? We have to see which is giving the analysis used by regulators that compares current market to historical market risk. No, there is no such. An analysis that looks for trends in VaR from period to period to future VaR. Okay, this seems to because we are seeing trend from period to period, predict future. Okay, we'll keep this. A method that computes VaR by assuming that losses in the future will occur with the same frequency and magnitude as they have in the past. So this is giving something about history. An analysis used by investors that compares current market risk to historical market risk. Current market to historical. So I'm a little bit confused between B and C. I'll go with C. If you are preparing for FRM 2, you already know how hard it is to find proper question solutions, but not anymore. In this video, I have already solved some examples for you, and if you like this video, if you want what you want in the next video, in the upcoming series, I'll include it. If you found even one concept clearer after this video, please hit the like button, comment which topic you want next, and subscribe so that you don't miss upcoming part 2 solution.